Okay, so there's bond mutual funds as well. And what we'll get into in a second is diversification. I know we're running up on time here, so I'll move quickly. But so mutual funds are a way to access the market and to get exposure to a broad-based set of securities. And there's active mutual funds, which means you have somebody trading on your behalf. And then there's passive mutual funds, or what we call index funds. You guys have probably heard of index funds before. So index funds, let's use the S&P 500, which is the most common index out there. When people say the market's up or down, they're usually referring to that or maybe the Dow Jones Industrial Average. But let's say we want to just buy the market. So we can take our $500 in the example we had before and just go buy an S&P 500 mutual fund. And there's a computer running it for us. We're basically there to match up the returns and the characteristics of the S&P 500 index for us. Those are a lot less expensive. I think we're even down in the 0.05 space now, or even less. 0.03, yep. And I know our ETFs are down to 0.03 now. Yeah. The mutual funds sometimes are a little bit more pricey, but yeah, they're down there. So that's a passive. So now you have that decision to make. Do I just want to own the market because I think the market in general is going to go up? Or do I want to be very specific in the types of companies I own? Okay? And that's how you can look at mutual funds and figuring out how you want to own the market. So there are, and we can go into a very deep discussion with this. I'm happy to continue it as we go. I'll answer it real quick. You're correct. A lot of studies have come out that have shown actively managed mutual funds have trouble beating the market in modern day, market situations. Most of those studies are done with larger company mutual funds, meaning that when we look at the S&P 500, we're typically buying larger companies, or larger companies are more represented in the S&P 500 because it is heavily tilted towards the larger companies, the index itself. You're not actually spread out evenly across all 500 stocks. And so when people are just throwing money into these stocks, it causes the S&P 500 to go up. And so the actively traded mutual funds that buy those type of stocks have a drag on them because of the fees they're charging. And so they underperform a little bit. And so why would you want to own an actively managed stock, and maybe in the large cap space, is if you think the market might go down. I'm hiring somebody that is going to hopefully make smart decisions in managing that portfolio in volatility. And that's where they can really earn their money. We just haven't seen bouts of volatility in a long time. And so actively managed funds tend to do a lot better when the markets are volatile. Now, with smaller companies and international, especially emerging market type countries, so the smaller countries out there, an active manager tends to do much better because there's a lot less known about these companies. They're inefficient. And so they're able to find opportunities that they could take advantage of that others might not. So if they're buying Shake Shack, there might not be a lot of people that want to buy Shake Shack, but there's a lot of people that want to buy Apple. And so they might find some opportunities to take advantage of inefficiencies in those markets. Does that make sense? Yeah. We could talk a little bit more about it. And then in the Q&A, it's a very good question, and I'll give you my personal opinion on it too. So exchange-traded funds have come about in the last many years. I think 1993 was the first exchange-traded fund that rolled out. An exchange-traded fund is somewhat similar to a mutual fund. You actually are buying a basket of stocks, but there's no, there's a bunch of different types of exchange-traded funds, but for this conversation, there's no manager. So there's nobody managing that basket of stocks for you. Okay, it's pretty static. There may be a change here or there, but you're saying, I want to own this basket of stocks. And that basket of stocks may mimic the S&P 500. So the first ETF that came out, exchange traded fund, came out in 1993. It was symbol SPY, and it's still around. Its nickname is a spider, okay, SPY, and it mimics the S&P 500. Okay, and so when you buy the SPY, which you can go on and trade it like a stock, whereas a mutual fund, when you own a mutual fund, it trades one time per day. Okay, you put your money in and then you get the price of that mutual fund at the end of the day. Whereas the exchange traded funds are going to trade back and forth throughout the day like a stock does. And so you're going to be able to buy it It's also going to give you a lot more liquidity and a lot more tax efficiency. Okay? So again, when you're pooled together in a mutual fund with all these other people, you're at the mercy of all of their decisions to liquidate. And if you don't want to liquidate, you could get stuck having to pay taxes even though you didn't sell. Whereas an ETF gives you a lot more control. And so you could buy an exchange traded fund on a lot of different basket of stocks out there. And you can go online and just research these things to death. There's about 2,000 exchange traded funds and almost, there's maybe close to 4,000 stocks. So there's a lot of exchange traded funds that own a lot of the same stuff. And the pricing on exchange traded funds have gotten really cheap. So 0.03 is the exchange traded fund that we have at Schwab that is now the lowest in the industry. Okay? Yes?